We do a bunch of stuff in zero DTs.
Every Thursday.
Every Thursday we do zero DTs. And today, got some cool stuff for you. Covered calls in zero DTs. We're going to look at bullish positions. Covered calls are a basis reducing strategy that takes existing long stock and adds positive theta component to that to increase your probability of profit. What that means is if you buy a stock, let's say it's whatever, 50-50 or something like that. And if you sell a call against it, it improves your probability of profit significantly, probably by 20-25%. And at the same time, it limits your upside. That's the whole trade-off. Okay, so in
the yin and the yang, the good
that
and the
is
bad.
the yin and the yang. So, and you can see right here, we gave you a SPY example. If you bought 100 shares of stock, your max profit is undefined, and your pop until June 50-50. But if you buy 100 shares of stock and then you sell a 25 delta call against it, the amount of money you put up is the exact same. Your max profit goes from undefined to limited, and your pop goes from 50 to 65, which is basically 25%, like I said.
Right, but we're looking at June here, not zero-day options, correct?
No, this is June. This is just showing you an example
Yeah,
of
just right.
just an
Set it up,
example.
I get it. I just want to make sure that
Covered call example.
understands.
Classic covered call. When you do covered calls, hopefully when stock's a little oversold, volatility's higher, that's perfect world. But whatever.
Net, you expect it to go higher. That's
Yeah.
when you do a covered call.
Covered calls are bullish positions, period. You can do covered puts too. Those are bearish, but short stock, short puts. But a covered call, long stock, long index, short calls. That's it. 1-to-1, whatever it is. If you're 10 to 1, whatever. In zero DTEs, we could do the same delta covered call and collect much less. If we put this on every day, what are the results compared to doing a typical longer duration covered call? So instead of buying stock and selling a call 45 days out, what if you bought stock and sold a call every single day?
That's a good one. Now, I have to assume from the data that we have, they couldn't pick a specific time in the day, like 2 o'clock in the afternoon, an hour before the market closed. It's probably closing prices, correct?
I don't know if he used closing prices the day before or opening prices the next day, but either way, it would work out the same over
Let
time.
me see if I can find out. Okay.
Okay, but either way, it would work out the same over time. Mm-hmm. So the question is, if you write a single call every single day versus if you did one 45 days out, what's going to work out better? Now, based on the fact that the zero DTs have a lot more premium, I'm going to guess that the zero DTs, writing a call every single day in the zero DTs, is actually going to work out better because they're so much richer premium-wise because it's just
all the
one day.
research we've done, even if you use 45 days, which is our optimal time frame, if you were to do it each week, over time you pick up like an extra week worth of premium. So I've got to assume the same as you that this is going to work out a little bit better.
So the net debit's the same. The net debit's the same. The max profit's obviously significantly less here because if you're going to sell a daily 25 delta option, you're selling one that's way closer to the money than if you were doing 45 days out. So your net profit's going to be, remember it was $1,300 before? Mm-hmm. It's $300 now. Mm-hmm. And your pop's going to stay exactly the same because it doesn't change your probability profit. Right?
That's
makes sense.
That's correct. I mean, the numbers are what they are. If it's 25 delta, it is what it is.
Yep. Let's do the next slide. So we did a study. We said if you hold 100 shares of stock and you sell 25 delta calls and you compared zero DTs to 45 DTs, what would happen? We recorded the P&L for the covered calls for one day if the SPY went up $2 or $4 unchanged or down $2 or $4. We also looked at the P&L on large up days where the SPY was up over $8. Okay. So we checked everything from 2.4 unchanged, minus 2.4, and then plus 8.
Which I mean, the plus 8 is a little aggressive of an up move, but the 2.4, that's about the average move in SPY. With a 19% implied volatility, it's a $400 stock. You're looking at a 1% move. It's there.
Yeah. Well, $8 moves 2%, but the other ones are 0.5%, 1%, and unchanged, which is totally fair.
That's what I'm saying. That's totally.
Yeah.
That's
Yeah.
okay.
Got it. Let's go next slide. Let's see how this worked out. So, looking at the up days first, the 0DT covered calls made between 20% to 100% more money than the 45 days. So we were looking for something positive. We were looking for a positive takeaway from 0DTs. Like, how can somebody who wants to use 0DTs find a positive trade, assuming that you're bullish? And we found was, and this is something that I guess really shouldn't surprise us, but if you're bullish and you wanted to buy an underlying like the SPY and sell daily calls against it, all right, instead of 45-day calls, unless the market really craps out.
It's going to be more feast, more famine.
Yeah.
It's really what it comes down to, which is exactly what you would expect. I mean, we always, the risk is the same probability, but since it's such a short period of time, that probably is going to play out each day.
Yeah.
So
like a day like today right now would not help you. A day like today would move against you.
Unless we had a comeback in the market.
Unless we have a comeback. But normally,
you'd be sitting with basically long delta right now,
Yep.
just all stock.
Now, just so you know, this is not the easiest thing to do because you're going to sell a 25 delta call and you're going to be like, okay, well, you don't have, there's a lot of days where
Fortune favors the brave.
a lot of days where it's going to cap you out, things like that. But whatever. On unchanged days, you profited the full value of the call in the 0DTE. But only a single day's theta on the 45 days. That's the whole difference. Mm-hmm. So we looked at here was we put the numbers up here, and if the this is the P&L, the 25 delta covered call. We did the 0DT and the 45 DT, and you can see here just on the 40 if the market's unchanged for the day, the 45 day DT makes a nickel and the 0 makes 40 cents. If the stock's up $2, you can just see you make more money. Mm-hmm. That's all it is.
Yep.
And on the down moves, you're going to lose a little bit more money because that makes sense. But the market's down less than it's up. So it's kind of common sense what you would think, but you make a little bit more money when the market stays unchanged or goes higher.
That's the extra kick you get for taking the extra risk.
Yep.
If we're unchanged, marginally one way or the other, you're going to make more money.
Let's go to the next slide.
Mm-hmm. It's a good study.
On down days, the 0DT covered calls lost roughly 25% more than the 45 days. Since the short call will go to zero quickly on a down day, you will essentially be long 100 shares with no protection. That's exactly what happens. So down $2, you lose a little bit more, but down $4, you lose a lot more. Down $8, you're obviously going to lose a lot more than that. Okay, we highlighted the part in red because you have no protection to the downside. Mm-hmm. I mean, other than the first first few pennies. Mm-hmm. Let's go to the next slide. So here's the only time on large up days, the 45 DT covered call outperforms the 0DTs because the upside cap on the 25 delta call is further out of the money. So the 45-day covered calls will outperform by almost 40% on days the market's up 2%. So if the market has a huge up move, then you're going to outperform on the 45 days because the other one's going to cap you out. The problem with the 0DTs is the move up is too much, you're gone, and if the move down is too much, neither of those don't help you at all. But anything in between, that helps you and you outperform. And most of the time, the market's in between. Let's go to the next slide. So the takeaways. On 0DT covered calls, we see roughly a 50% greater P&L on up days and a 25% P&L worse on down days than the 45-day covered calls. Now let's stop here for 1 second. This morning we talked about pot odds. Mm-hmm. And if you're talking about a 50-50 bet here, which the market really is, then the 0DT calls against your P&L on 100 shares of SPY, let's say, your good days are going to be 50% greater than your bad days, which are going to be 25% worse. And that's the 50-50 shot with pot odds. Okay. However, large up days will always be capped on zero because DT covered calls because the same options are much closer to the money than you would get if you went out 45 days. The point here is, if you were looking for a strategy for a bull market that you liked for a bull market, you want to sell daily 0DT options against it, it's reasonable because you got good pot odds. You make you make 2 times for every time that you lose. That's pretty good. If you're bullish.
If you're bullish.
Yeah.
If you think you can get direction right more times than not.
If you're just long, you want to hold on to it. It's something you want to do every single day. It's worked out nicely. Whatever. That's all we put out there.
Very good, sir. Let's have a quick 90-second break and come back. We've got Joy, your friend and mine, Mr. Scott Sheridan, next with Tasty Live.